Hello participants, I am Dr. Sonal Jain. In this session, I am going to talk about goods and services tax. It is an indirect tax which has replaced many indirect taxes in India with the motive of having one taxation law for the entire country. The Goods and Services Tax Act was passed in the Parliament on 29th March 2017 and came into effect on 1st July 2017. In other words, if we say GST is levied on the supply of goods and services, at present, petroleum products and alcoholic liquor are kept out of the purview of GST. Hence, both of these are at present being controlled by the respective state governments. These are the taxes which were there in the system before GST was introduced. These are central excise duty, duties of excise, additional duties of excise and additional duties of customs, special additional duty of customs, cess, namely Swachh Bharat cess, Krishi Kalyan cess was there before GST, service tax, state VAT, central sales tax, purchase tax, luxury tax, entertainment tax, entry tax, taxes on advertisements, taxes on lotteries, betting and gambling, etc. All of these taxes have been replaced by the GST. When we look at the journey of GST in India, then we can see the idea of moving towards GST was first of all mooted by the then Union Finance Minister Shri P. Chidambaram in his budget speech for 2006 and 7. Initially, it was proposed that GST would be introduced from 1st April 2010. The Empowered Committee of State Finance Ministers, which had formulated the design of state VAT earlier, was requested to come up with a roadmap and structure for the GST. The Empowered Committee then came out with the features of the proposed GST and has formed the basis for the discussion in between the center and the states. Thereafter, there has been a constant endeavor for the introduction of GST in the country, whose culmination has been the introduction of the Constitution 122nd Amendment Bill in December 2014. Later on, this bill was passed in Lok Sabha in May 2015 and then in Rajya Sabha in August 2016. The Constitution 122nd Amendment Bill 2014 was then approved by the then President Shri Pranab Mukherjee in September 2016. And it became Constitution 101st Amendment Act 2016. This 101st Amendment gave powers to both central and state government to make laws relating to goods and services which earlier were under the ambit of either central or state government. After that, 4 supplementary GST bills, namely CGST Bill 2017, IGST Bill 2017, UTGST Bill 2017, and GST Compensation to State Bill 2017. These 4 bills were passed in Lok Sabha and approved by the Cabinet in March 2017. Then GST was launched on 1st July 2017 midnight by the President Shri Pranab Mukherjee and Prime Minister of the country Shri Narendra Modi, having midnight session of both the houses of parliament convened at the Central Hall of the Parliament. GST is also known as the destination-based tax and levied at a single point of time of consumption of goods or services by the ultimate consumer. As we know, destination-based tax is the taxation based on destination or consumption of the goods or services. It means tax should be levied and collected and should accrue on the goods in the destination state and not the origin state. I can explain you with the example over here. Here, I have made a list of supplier states and the receiver states. Supplier states, let's say in the first example, is Delhi. Receiver state is Tamil Nadu. It means the supplier, the person who is selling the goods, is having his business in Delhi, and someone from Tamil Nadu has ordered for the goods to the person who is selling the goods in Delhi. So ultimately, we are assuming over here the seller has to deliver the goods to Tamil Nadu. So goods would be traveling from Delhi to Tamil Nadu. In that case, destination is which place, Delhi or Tamil Nadu? Here, destination is Tamil Nadu. So the tax will be collected by the respective state, that is Tamil Nadu in this case. In the next case, supplier is in Delhi, receiver is in Delhi, both the people are in Delhi. So destination of the goods is Delhi only. So tax will be collected by Delhi government. Okay. So another two cases, you can just pause your video over here, look out for the answer, and then resume playing. After that, I will explain the reason. Now, in the third case, good supplier is in Rajasthan and receiver is in Nasik. So destination R is Nasik. So which state should be collecting the tax? Is it Rajasthan or Nasik? Or I can say Maharashtra, because Nasik is in Maharashtra. People generally get confused with this name of the city. If we are saying Nasik, so people say Nasik will be collecting the tax. No, Nasik is in Maharashtra, so Maharashtra state will be collecting the tax. Similarly, in the next case, Pune to Mumbai. So destination is in the same state, although city are different, but it is in the same state. So Pune to Mumbai, it means Maharashtra to Maharashtra. So destination based tax will be collected by the Maharashtra government. I hope it is clear to you guys. Now moving on to the advantages of GST. First one is removal of cascading effect. During the pre-GST regime, every purchaser, including the final consumer, paid tax on tax. How? I will be showing you. This condition of tax on tax is known as the cascading effect of taxes. GST has removed the cascading effect. Again, I will show you with the example. Tax is calculated only on the value addition at each stage of the transfer of ownership. In the case of goods and services tax, there is a way to claim the credit for tax paid in acquiring input. The individual who has already paid a tax can claim credit for this tax when he submits his GST return. That is known as claiming credit on the taxes paid. ITC, input tax credit, is another concept in that, which also we will be covering. Now, looking at this example, this is the calculation of taxes and the final pricing of a particular product before GST was introduced. Here, manufacturer produced a unit, and let's say that unit could be a remote. He has produced a remote, let's say, or a remote game, you can say. So manufacturer, he incurred 100 rupees. His working cost was 100 rupees. So he incurred 100 rupees for the same. So it became his cost. After that, assuming that the tax rate is 10% into the system, so we have added 10% on this 100. The invoice price came out to be 110. 100 is the cost, 10% is the tax amount. So 110 is the amount he is charging from the buyer. And buyer over here is the next person in line, who is the warehouse manager or the person who is warehousing it. Okay. So let's say wholesaler has bought it and he has put the material in the warehouse. So wholesaler has incurred further 20 rupees on one unit to warehouse that particular product. So extra cost, he further incurred 20 rupees. He bought the same for 110. He added his own 20 rupees which he has spent on his work, and the cost to him came out to be 130 rupees. Again, adding 10% tax on 130, that is 13 rupees, the invoice pricing came out to be 143. This is the amount he is going to charge from the next buyer. Next buyer in this line is the retailer. Retailer has bought the same for 143 from the wholesaler, and he further incurred 10 rupees on particular one unit, let's say packaging cost or advertisement cost, whatever cost may be. He further is increasing 10 rupees in the cost amount. So 143 he spent to buy it, 10 rupees he further incurred, 153 became the cost. 10% tax comes out to be 15.3. Final invoice came out to be 168.30 paisa. Now, initially, an item which was produced for 100 rupees, ultimately to the end consumer, it is reaching for 168 rupees and 30 paisa. So, consumer has to pay 168 rupees and 30 paisa to buy one unit of remote game from the market. Now, irony of the taxes earlier was tax rate on face looks like to be at 10%, but it was not so. How? Let's see. Manufacturer incurred 100 rupees, where wholesaler incurred 20 rupees, retailer incurred 10 rupees. Total cost of producing this unit was 130 rupees. Whereas on this 130 rupees, taxes amount is coming out to be 38.30 paisa, which is somewhat around 29% of the cost. On face, it looks like 10% of the cost, but in actual, it is around 29% of the cost, which is coming out to be. Hence, consumer has to pay this. And why this 38.3 amount is coming out to be? Because this 10 rupees, which wholesaler paid to the manufacturer, this has been included in his cost, and further 10% on this 10 rupees was calculated. Again, these 23 rupees were added into the cost of the retailer and tax was calculated accordingly. So one is calculating tax on the tax. So this is how there was the cascading effect into the picture. Now, how GST has removed it? As I said, that there is a procedure to claim credit for the taxes which one pays while buying the goods. There is a procedure. So if you are, while buying inputs, if you are paying certain tax amount, you can claim that tax amount from the tax you are collecting from the other one. Let's say here, if you are collecting 13 rupees from retailer, then from this 13 rupees, you can reduce the 10 rupees you pay to the manufacturer, and the balance 3 rupees you have to pay only. So one can adjust the taxes paid from the taxes collected, and the balance needs to be paid to the government. Okay. Now let's have the same example. Let's understand the picture of the same example post GST era. Let's see that. So post GST, we are having the same cost the people are incurring with the same tax rate. Now let's understand this scenario over here. Manufacturer incurred 100 rupees, which became his cost. Adding 10%, 10 rupees on 100, invoice price is 110. Now, in pre-GST era, the buyer used to count 110 rupees as his cost, but post-GST era, buyer will segregate the two. Buyer will count cost into the cost and tax into the tax. So here, buyer has taken out of this 110, buyer has segregated this because in invoice you mentioned both the things separately. So 100 rupees buyer is counting as cost and 10 rupees buyer is considering as the tax. Okay. Now this 100 Adding 20 as cost of warehousing, the new cost coming out to be 120. 10% of the tax is coming out to be 12 rupees. So invoice price is 132 rupees. Now, how ITC works? As I said, ITC input tax credit is basically adjusting your input tax from the output tax. Warehousing person, who is the wholesaler, he is collecting 12 rupees while selling the goods, right? So this is his output tax, and while buying the goods, he paid 10 rupees tax. So difference in between the two, that is of 2 rupees, he will pay only to the government. 10 rupees will be submitted to the government by the manufacturer. 2 rupees will be submitted by the wholesaler to the government, and retailer who is buying the goods for 132 rupees will further segregate the two into the cost and taxes. So out of the 132, 120 would be cost, 12 would be taxes. Adding his cost to the 120 rupees, that is 130, the cost, new cost. 10% of the taxes coming out to be 13 rupees, and invoice pricing is coming out to be 143. Please understand, retailer, while paying taxes to the government, will adjust his input tax from the output tax. From the point of view of retailer, output tax is 13 rupees and input tax is 12 rupees because he bought it. Adjusting the two will give me the difference of 1 rupee only, which he will be submitting to the government. So 10 rupees to the government was submitted by the manufacturer, 2 rupees was submitted by the wholesaler, and 1 rupee was submitted by the retailer to the government. In all, 13 rupees were submitted to the government by the people who are there into the supply chain thing. Total cost incurred was 130. Total tax paid to the government was 13, making it the final price of 143, whereas in pre-GST era, it was 168.30 paisa, and in post-GST era, as we can see, it is 143 rupees only. So prices have been reduced because cascading effect has been reduced, right? It has been removed basically. Going back to the advantages again. There has been uniformity of rates. It is one of the crucial benefit people have got, or the country has got with this advantage, because government introduced GST with one motto of one nation, one tax. It means for the entire country, there would be one tax rate for one kind of product. Because earlier you may have noticed, if you are buying, let's say Maggie, or you can, best example one can see is of bread. We all have been eating bread since so long. So Britannia packet, one packet of Britannia bread, if you might have noticed, so there used to be different price rates mentioned in the packet, and it was written as, let's say, I am from Delhi, so I can give that example only. So there used to be written like, in Delhi 22, outside Delhi 23 rupees. So this kind of pricing have been done on various products. I can recollect Maggie only, Britannia bread only right now, but this have been done for many products. So why is it so? Because earlier the power to decide about the rates of product was lying with the state governments, respective state governments. They used to determine the rates of their products. So let's say Delhi government has kept 10% rate for one particular product. So Gujarat government has kept 12% rate for that for the same product, whereas Bihar government has kept 4%. So every state are having different rates, which may lead to different pricing of the same product. So to remove that kind of thing, government came up with the motto, one nation, one tax. It means for the entire country, there would be one similar rate of GST for for the same product. So uniformity of rates is obviously there after GST. Number of separate compliances is lesser now with GST, because earlier VAT, excise, service tax, these were there. So they had their own schedules of filing and compliances. GST, it requires a single return to be filed while comparing with 3-4 taxes. If you are having 3-4 taxes, you need to register in all the portals. You need to file all the taxes. But after GST came into the picture and GST replaced all these taxes, then you have to deal only with GST, not with other 4 taxes. Talking about e-commerce businesses, earlier, supply of goods across the border came under variable tax laws. Again, driver who was delivering driving the truck, that person required to keep the necessary documents along with VAT declaration, registration number, and other things. After GST came into the picture, more or less, it has eradicated all such complications and by paving the way for seamless transactions. Being technologically driven, the entire process of registration and filing of returns is accelerated. It also ensures that the process is clean and tax collection is done legitimately. The online portal of GST, it supports various activities such as registration, filing of return, refund process, responses to the notices, consumer grievances, etc. There are 3 taxes mainly applicable under this system, and these are CGST, SGST, and IGST, as we can see. CGST, which is known as Central Goods and Service Tax, it is the tax collected, as the name says, by the central government on the intra-state sale. Intra-state, within the state, it means. SGST, again, as the name suggests, it is state government goods and services tax. So it is collected by the state government on an intra-state sale again. But IGST, as the name says, it is integrated goods and services tax. So it is collected by the central government for interstate sale, and then after collecting it, central government shares the share with the respective state government which is eligible to collect the tax based on the destination based taxation system. As I was saying, that CGST and SGST are collected on intrastate sale, whereas IGST is collected on interstate sale, then I have classified it like that. But before that, one more taxation is there, and that is UTGST, where state is there, then SGST will be applicable. In case of Union Territory, UTGST will be applicable. So either state or UT, either of the two would be there. So when there is a sale in between, within the state, then CGST plus SGST would be applicable. When there is sale within the Union Territory, then CGST with UTGST will be applicable. But when there is sale outside the state, that is interstate sale, then IGST will be applicable. Now you are seeing that there is in the formula CGST plus SGST, CGST plus UTGST, but on the other hand, in the third one, only IGST is there. As I was saying, IGST is collected by the central government and later on, it is shared equally with the respective state. Okay, so I can say that rate of CGST plus rate of SGST or UTGST, whichever it may be, is equal to rate of IGST. So if someone says that the rate of GST is 10%, then it means IGST is 10%, CG and SGST are 5%, because both center and states, they share the taxes equally among each other. Revenue is being shared equally among the center and the states, or among the center on the unions, union territory. All right. Let us understand this with the help of example, which kind of tax would be applicable in this transaction. supplier and receiver. Okay. Supplier is in Delhi, receiver is in Tamil Nadu. So is it intrastate or interstate? It is interstate. Hence, IGST would be applicable. Delhi to Delhi, within state, CGST plus SGST would be applicable. Delhi to Nasik, Rajasthan to Nasik, interstate, IGST would be applicable. Pune to Mumbai, same state, CGST plus SGST. Chandigarh to Chandigarh, let me tell you, Chandigarh is Union Territory. So Chandigarh to Chandigarh, within Union Territory, so CGST plus UTGST would be applicable. Chandigarh to Lucknow, interstate, so IGST would be applicable. Now, in these cases, 3 cases of IGST, can you understand which state will be sharing taxes with the central government? In case of Delhi to Tamil Nadu, destination-based tax, so tax will be collected or enjoyed by Tamil Nadu state because this is a destination. So IGST first of all will be collected by the center, and center later on transfers half of the amount to Tamil Nadu government. Rajasthan to Nasik, again IGST will be shared by Maharashtra government. Chandigarh to Lucknow, UP government will be sharing the taxes equally with the central government in this case. GST Council. It is an apex member committee to modify, reconcile, or to procure any law or regulation regarding GST in India. The council is the key decision-making body that takes all important decisions regarding GST. It dictates tax rates, exemption, due date of firm, tax laws, deadlines, special rates for special states. These things are being taken care of by GST Council. Main responsibility of the council is to ensure to have one uniform tax rate of GST across the nation. The council consists of 33 members, including one chairperson. So 33 members, one is chairperson, and chairperson is always Union Finance Minister of the country. At present, Srimati Nirmala Sitharaman is the Union Finance Minister, so she is the chairperson of GST Council. Along with her, there are further 32 members in the council. These 32 members consist of one Union Minister of State Finance, and 31 members are the ministers in charge of finance or taxation or any other minister nominated by each state government. Now you might get confused by 33 members. We don't have that much states because we have Delhi, Puducherry, and now Jammu and Kashmir Union Territory because they have their own state legislature. So there are 33 members in the council. Quorum for council meetings is 50% of the total members. So 50% of the members should be present to fulfill the quorum requirement. While taking the decision, so decision is taken by 3/4 majority. 3/4 majority means 75%, wherein central government would have the weightage of 1/3 of the total vote cast, and state government would have a weightage of 2/3 of the total votes cast. Since the implementation of GST, council meetings are held regularly from time to time to discuss about any kind of change, discuss about the situation, to take any decision regarding the GST, considering the situation into the mind. Recently, 43rd council meeting took place virtually on 28th May 2021.